be considered an employee, certain characteristics have to be present. And the law covers how we handle taxes and different things for these people. They can be an employee, or they may be considered an independent contractor, and there's a difference in how we handle it. Right, taxes are handled differently on those people. So, an employee, I'm going to let you read through most of this. This is the law, and it's just a description, and I'm just going to kind of go through it. But you need to read it carefully so that you understand it. For an employee, the employer provides the tools they work with and tells them what to do, tells them what time they have to be there. And in other words, he is in control of how the job is done and that person doing it. There's laws. We've had all kind of laws passed. You're familiar with the minimum wage law. There's certain things that an employer must comply with when dealing with employees. And so we're looking at, I'm going to let y'all read. There's no point. You're not going to get questioned about the law, but you do need to know how it all came about, why we have these rules. Minimum hours of pay. Used to, long time ago, before the law stepped in, children were starting working at 6 and 7 and 8 years old in factories. They weren't going to school. They were being grossly underpaid and overworked. And even in New York now, you've got places that have foreign people coming in, and they pay them almost nothing, and they're working right. But the law has tried to come in and protect the employee. So there are laws that apply to number of hours and when you have to pay overtime, the minimum wage. So the main thing is 40 hours is considered a full work week. If a person works more than 40 hours in a week, they're entitled to time and a half, whatever their wage is, their hourly wage, plus a half, right, yeah. Plus a half over. And so there are, that helps to protect the employee from being overworked. The amount of Social Security tax is determined by a rate, a certain percentage. Everybody that's drawn a paycheck has had Social Security taken out because it's a requirement, unless you're an independent contractor. But if you're an employee, the employer is required to take out Social Security. So, how much they can take out and how long they take it out of your check is based on a certain percentage rate of your pay, and it's based on how much you've made that year. I would just be hoping that all of us would fall into this bracket of making more than 106,000, right? So that they don't have to take Social Security out anymore. Okay. Not many people do, right? So, if a person reaches $106,800 in 1 year total pay, then they don't take Social Security out beyond that amount. So once you reach, well, I confess that all of y'all are going to reach that and y'all go to work. Once you reach that point, after that, you wouldn't be the percentage would not be deducted from the paycheck. So this is the annual amount.
They do that to have companies.
Yeah, most of them are making more, right? Yeah. So, up to that point, they charge it. Once you reach it, like if you're on your next paycheck, you were going to reach, you made $2,000, they could only charge you, take Social Security out of $200 on that next check. So, they don't take anything out over that amount. I'm telling you, be nice on it. And this increases. This is as of 2010. So the law, these guys are over there making laws regarding taxes all the time. The tax book, the tax regulations is a huge book. It gets changed constantly. But being a tax accountant is very profitable. It does require you to stay on top of all the taxes, but it's also one of the reasons the accountants that are in that profession make a lot of money because they have to stay on top of it. Well, I hope not. That's the wind. Okay, so Medicare is also required to be deducted from everybody's employee paycheck, and it is has a percentage rate. It's also set by law, but it's on total earnings. There's no cap on it. In other words, no matter how much you make, they take out the 1.45%. Social Security has a cap. Medicare does not. And that has remained constant in the last years. So has the 6.2% has remained relatively constant on the Social Security for a while. Now, okay. Everybody okay? Those are the two things we will be dealing with when we are looking at taking out deductions and figuring out our payroll. Yeah. Okay. Okay, states and local governments and the federal government requires that we take out income tax. Arkansas is one state that does have an income tax, and some local. Some, even within the state, sometimes you have a local income tax. Here we do have a state income tax. So, we're required as employers to take out an amount for income tax. And the rules for the state and the federal are usually pretty close as far as what they require you to look at and what deductions can be taken, how many deductions you claim. All right, let me get down here. Federal, well, we didn't talk about it much, did it, on the slides. Your income tax is based on how much money you make, and on how many deductions you take, what category you file in. If you go to work somewhere, you're going to fill out a W-4 form in which you tell them how you're filing, whether you're filing single or married or head of household, and then you list the number of dependents you have. And so you fill out that W-4, and they give it. Our employees give that to us, and then we can determine how much income tax to take out of their check. Okay. Also, employers pay other things that are considered benefits to the employee. Actually, the employer is also required to pay federal unemployment tax and state unemployment tax. Now, these two things are what the employer has to pay to cover people that get laid off, right, or fired. That's where this unemployment comes from. This is sort of an insurance type thing that the employer has to pay. Now, employers that do a lot of laying off pay a higher rate because they're penalized for not keeping people steadily employed. You know, if they're habitually bringing people in and keeping them for a while and they're not wanting to do whatever, or for whatever reason, they lay them off, and they're doing this regularly, then they're going to be penalized. They're going to have to pay a higher rate of insurance because more and more of their people are going to collect, right? So it's sort of like your insurance on your automobile. If you have an accident, you get charged more. Same kind of thing. Okay. And a lot of them will get around that by using temporary employees. They don't want to have to deal with, you're right, with paying all the taxes, so they'll hire people in through temporary agencies to work so that the temporary agency has to handle all the taxes. Yeah. And some of them try to classify people as contract labor, right, to avoid having to pay all this. You'll see why in a minute, because this is a cost to the employer that is required that they pay for on each employee. Plus, employers also have to pay workman's compensation, which is another insurance type thing that they have to pay in case somebody gets hurt on the job. Exactly. And so we call it FUTA and SUTA. That's your federal and your state. Applies to a taxable earnings base. So that's based on our total payroll. We pay that. Okay? That's the employer's part. In our textbook and in our problems that have to do with payroll, $7,000 is going to be the earnings base. So every year, the first $7,000 that each person earns for your that works for you, you would be charged this insurance on. After that, you don't. It's just on the first $7,000 that each person makes each year. Okay. The law. Workman's comp protects the employees for job-related injuries that they receive on the job. It would pay their medical expenses. As employers, we're required to keep up with all our employees, all this information about them, their Social Security, how much they work, weekly wages. So we would have a record of from the date we hired them. We start keeping up with how much we pay them throughout that year, each year. And we keep up with their cumulative wages, because at the end of the year, we have to send the employee a W-2 showing what they earned, right? And how much we took out. Everybody received a W-2 before, probably. And then we also have to send a copy to the government, so they have something to compare when that person files their taxes. Okay. We have to keep up with the amount of income tax we take out, security, and Medicare, everything, so that all that shows up on the W-2. If you've ever gotten one, you see everything that they took out, except for your insurance and stuff like that. Okay. We have to be sure that these people are citizens or have a valid work permit before we hire them, right? Well, we would hope that this happens. Now, let me go back to one part. The Social Security part that the employee pays 6.2%, the employer has to match that. So the employer's cost for having a payroll, for having employees, is, in addition to what they pay this person, they pay another 6.2% of their salary for Social Security. And they have to pay the federal unemployment tax on that person, state unemployment tax on that person, and the workman's compensation. So there's a benefit amount that is over and above what that person's actual salary shows. So the employer, by having the employee, has to pay. Okay? And you do need to read carefully through your book, because it covers these details. All right. Calculating earnings. How do we compute how much a person earns, and then how do we determine how much to take out? And how do we end up with the net pay so that we can prepare the checks and send it to the people, right? All right. First step is to determine how these people are paid. Some people are paid hourly. Some people are on salaries, and some by commission. And some by the piece rate. In other words, they're paid for how much they actually produce, how many widgets they make in a day, right? You get paid like a shirt factory. And sometimes they'll have a quota, correct? They'll have a quota. You have to do this many, and then anything you do above that, we're going to pay you extra. Or a little more for, which is used as